Welcome to our video today, where we will be exploring the topic of loans and mortgages, a risk for banks. We will delve into the intricate world of finances and examine how they affect the operations of banks, particularly in a volatile economic landscape. After learning about this crucial aspect, don't forget to subscribe to our channel to stay updated on future insightful content. Before diving into the complexities, let's first understand what loans and mortgages actually are. Both are forms of financial borrowing. A loan typically refers to an unsecured financial facility where the borrower gets a specific amount from the lender and commits to pay it back within a definite time period, with interest, while a mortgage is a type of secured loan specifically used to purchase real estate, where the loan is secured by the collateral of a specified property. Having learnt the basic conceptual differences, let's move on to the aspect of risk. The question stands, are loans and mortgages risky for banks? The simple answer is yes. Banks bear a significant risk in extending loans and mortgages, and here's why: they primarily deal with their depositors' money and making it available to borrowers. In doing so, they assume the risk of non-repayment by these borrowers. Banks meticulously assess borrowers' creditworthiness and capacity to ensure that they can indeed fulfill the terms of the loan or mortgage. Nevertheless, unpredicted circumstances or financial complexities can steer borrowers into financial hardship, thereby affecting their repayment capacity. If a significant number of borrowers default, the bank's financial health suffers. Rapid shifts in the economic environment can further elevate the risk. During a recession, for instance, the unemployment rate typically rises, impacting the income stability of many borrowers. The value of properties can also drop significantly. When these events transpire, borrowers may begin defaulting on their loans, magnifying the financial risk for banks. Yet, the risk associated with the loans and mortgages does not simply stop at potential non-performing loans. Banks also bear other associated risks. For instance, interest rate risk, the probability that changes in market interest rates will impact a bank's revenues or expenses. This risk is particularly prevalent in the case of adjustable rate mortgages. There's also the risk of liquidity. Given that banks use the depositors' funds to extend loans and mortgages, the lack of readily available funds to meet these financial obligations, if ever needed at short notice, can pose a major problem. Economic downturns, for instance, can result in depositors simultaneously withdrawing their funds, leading to a liquidity crunch. Lastly, there's the credit risk. Considering that banks are fundamental in channeling credit to the economy, a widespread credit downgrade or economic instability can lead to many borrowers failing to pay, gradually eating into the bank's profitability and overall asset quality. In light of all these risks associated with financing, it's critical for banks to manage their loan and mortgage portfolios efficiently. They often do so through diversification, spreading their lending across a range of industries and geographies, which is aimed at minimizing the risk of significant losses occurring from a decline in a single industry or sector. They also employ risk-based pricing strategies, charging higher interest rates or demanding more stringent criteria for high-risk loans to counter the higher potential losses. Not to forget the risk mitigants like collaterals or insurance to cushion against potential losses triggered by the default of the borrower's repayments. Moreover, banks often turn to the secondary markets to offload the risk associated with these loans or mortgages. By selling off these debts to other entities, banks can free up capital and manage their risk exposure prudently. Striking the right balance between risk and opportunity is crucial for both the banks and the society at large. Although inherent risks exist, loans and mortgages form the backbone of the economy, fostering economic growth by providing individuals and businesses the capital they need to spur financial activities and prosper. Financial institutions, recognizing the perils and possibilities, continually strive to improve their methods for assessing and managing risk, using innovative technologies and advanced analytical tools to achieve a more comprehensive, data-driven understanding of consumers' credit behaviors and repayment capacities. Regulators also play a significant role in supervising and advising banks on how to manage and mitigate these risks. By enforcing stringent prudential regulations and maintaining a robust financial system, they attempt to ensure that the banking sector sustains potential challenges and contributes significantly to the economic development of the country. In sum, while it's undeniable that loans and mortgages pose risk to banks, especially in turbulent economic conditions, it's equally important to recognize the significant role they play in driving economic growth. Few other financial products have such a widespread impact on the economy, making the management and mitigation of these risks a paramount topic for both private and public sectors. As we close, we hope the video provided you with a better understanding of the topic. If you have any questions or thoughts you'd like to share, please feel free to do so in the comments section. And if you enjoyed this video, don't forget to subscribe to our channel for more thought-provoking and informative content. Until next time.